The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and exciting holiday weekend. We were, of course, on hiatus for a few weeks due to the holiday and due to Mr. Schlesinger's busy schedule. But now we are back in full force, and we have quite the motley crew here joining us today. Of course, I am joined, as always, by my ever-faithful companion, good old Don Schlesinger from VolX. Don, how was your holiday weekend, sir?
Everything great. Enjoyed a little bit of rest. Happy to be back.
We are also joined, at least temporarily, by the Seabass, our volatility pit reporter, good old Mark Sebastian from Option Pit. Mr. Sebastian, how are you doing today, sir?
Oh, I am like a kitten swimming in a pool of milk.
At least that's a little less disturbing than the other imagery you used before, so that's an improvement.
Mark, it's the imagery I'm going to use in a few minutes.
The imagery you already used and our listeners will be enjoying shortly. And listeners, we are joined also by a special guest this week. A lot of our listeners, regular listeners of the Options Insider Radio Network, are familiar with good old Uncle Mike Tusaw from Know Your Options, Inc. He is a regular on our Option Block program. But he is not the only Mike over at Know Your Options. Oh no, there is another Mike, his better half. Good old Mike Cavanaugh, and we are joined by him today. Mike, how are you doing? Welcome to Volatility Views, sir.
I am excellent. Thanks for having me. And the other Mike is a better moniker than if you were going to call me Aunt Mike. So
yeah, I don't think Aunt Mike goes very well.
No, I like Grandpa Mike. You know,
Grandpa Mike. I'll take that.
I like that. No, well, you've got to both like Uncle Mike's. You know, Mike Tusaw is kind of your uncle that lives in the backwoods that you see once a year, and he wants to take you hunting. You're more like the uncle that pulls a quarter out of the ear. And takes everybody to Great America. You know,
I'm the fun uncle.
Yeah, exactly. You are the fun uncle.
He sneaks some beers to his teen nephews and is generally a bad influence on all around him. But yeah, so now with our team assembled, we will roll right into the volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we discuss what happened in the previous week in terms of volatility. And we'll kick things off with good old Mark Sebastian, our Option Pit reporter. Mr. Sebastian, what were you watching over the past week in volatility?
An absolute demolishment. Is that a word?
Demolishment? I like it. If it isn't, we'll have to petition the dictionary to add it.
I mean, I'm really impressed by the ability of traders to look at everything and say, you know what, I'm going to sell premium here, because that's all people are doing. You know, you and Mark and I, we're talking on a Friday, and the S&P 500 is down 15 handles, and volatility's blipping, barely up. If that, it's just insane. I was reading a piece. Jeff Ogden sent me a piece today about how he thinks that a lot of volatility modeling isn't right, and I agree with him. We're moving more than the way option pricing models are calculating a volatility at. I mean, I don't buy into some of the vol numbers that are put out there. I think we just had these huge ranges, and we're getting kind of range-bound you ever heard of range-bound volatility? That's kind of what I think we're in. Range-bound volatility. So, and I think that's what we're looking at is we're stuck between 1250 and 1350, but on any given day we can move 20 handles. It's insane.
Yeah, you almost have two notions of volatility. You have the broad, macro, large moving volatility, and you have the vacillating around a particular handle for several weeks volatility. And I tend to agree. I'm not sure if the metrics and the models right now tend to take both fully into account.
They don't. They're good at the one. They're not so great at the other.
I know you were short the VXX last week. Are you going to get long now, considering that most of these models under-report volatility, or you think they're just hopelessly flawed?
VXX is way too flawed to ever buy. I would never hold VXX for more than a couple hours. If I was going to get long, it's really easy to get short vol in these ETNs. It's really hard to get long volatility in these ETNs. So, I would, if VolX had a realized contract, I would be buying it. Let's just put it that way on S&P.
I keep telling them that, and they're looking to add it. So I think once they get all their ducks in a row, that'll be the next thing that they add to their list. I know they're looking to expand beyond the realm of Euro.
Yes, I know.
Thank you for that, Mr. Sebastian. And Don, what's been happening in the world of Eurovol since we last spoke?
Well, it's been 2 weeks since our last show. And so basically we are right at the expiration, which is about to take place. A little bit more calm than some of the other expirations. And you might recall that when we last spoke, I think our front month July contract was at about 13.5 or so, all the while the forecasts for the settlement were somewhat lower in about the 12.5 range. It looks like those forecasts were right on the money, because as we come into the expiration, settlement last night was about 12.09, and the accumulated or partial volatility was at around 12.14 or so. So it looks like we're going to settle in at today's close at the expiration in the low 12. So we'll have the new front month, the 1 month contract for August coming up for Monday, and we continue with the 3 month product, which is the September 3 month vol, which is about 24 or so days into the 69-day period.
All right, thank you for that, Mr. Schlesinger. And now with our volatility review complete, we will roll right into our volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is where Don and I usually grab some poor soul from the world of options and volatility and drag them onto the program, where we proceed to pick their brains. And today's victim is, of course, good old Aunt Mike. I mean Mike Cavanaugh from Know Your Options, Inc. And again, welcome to the show, sir. It is good to have you on Volatility Views and get a break from that other guy, that Uncle Mike guy who's always talking on my various programs.
Yeah, no, thanks for having me. I look forward to sharing some views with you.
Now, obviously, a lot of our listeners are familiar with what you guys do over at Know Your Options because of Mike Tusaw and his presence on our various shows. But why don't you give our quick wrap-up, a quick rundown for some of our listeners who are specific to Volatility Views on what you guys do over at KYO?
Yeah, it's kind of twofold. We've got a lot of clients that we will put in a non-discretionary model where they want to make their own decisions. They don't want to trust an advisor to drive the bus for them, but they still want to have a sounding board. Talk to an advisor that uses options, that understands risk, assessing risk, and the management of risk to help them with their investment decisions. And then we do have clients that say, hey, you know what? I know just enough to get in trouble, and I don't have the time to educate myself on risk management and how people have success in investing and trading using derivatives. Can you do it for us? So, whether the client wants to do it on their own, has an understanding and a grasp, but they still want that extra sounding board, or they don't have the time or they don't have the desire to educate themselves and they just want to turn it over to us, we can help both kind of people.
And now, since the purview of this program is around volatility, let's dig into that a little bit as well. I mean, obviously, you have a broad spectrum of clients, some who are very well-versed in options and others who are less well-versed in options, let's say. But what role overall would you say that vol and volatility plays as you're putting together these portfolios and doing your financial planning for your clients? Like, let's say right now, obviously, we're in a very volatile environment. Volatility is moving quite a bit. The broad indices are moving quite a bit. We've had just a significant rally in the broad markets, and people are a little worried, a little precarious about these current valuation levels. Are you looking at the broad volatility levels right now and saying, okay, this is the time when we want to be hedging our gains and taking advantage of some of these broad reductions in volatility to get some cheap protection? I know you guys are very active in collars over there, so is this a time when you guys are readjusting and tightening those collars and taking advantage of these low volatility levels to protect your clients a little more?
Yeah, no, it's a great question, and it's the difficulty when you start incorporating volatility into long-term portfolios is you have to be right in your sentiments on volatility. And what we've noticed with time is you may be right. Like volatility historically, if you look back over a 1,000-day moving average or even a 5,000-day moving average, volatility is roughly in the middle of the road here. I think the million-day moving average on the VIX is like 15.5. So some people would argue that volatility is slightly high. And there was a good period of time from 2004 to 2006 where the VIX was at or below 10. So in our collar portfolios, the mechanism of hedging, we don't base the sentiment on where volatility is. So for people that aren't aware of a collar, you own the underlying, you own a put, and you're short a call. So if we're long a put and short a call through the next 10 years, when we sell the call, if volatility is low, we're selling a low volatility. But at the same time, we buy a put, and that put has an equally low volatility. When volatility is high, we're selling a high vol call, and we're buying a low vol or buying a high vol put. So the volatility with time tends to smooth itself out because we're always short vol and long vol at the same time. Now, we can shift those parameters if we gain a sentiment, or if we have an adamant sentiment on where we think vol is going. We can shift the time focus on the put to get a larger volatility exposure. So, if we're in the front month where we own the put in the front month and we're short the call in the front month, our volatility exposures are going to be relatively close. But if we buy a longer expiration put, we're going to have a longer vega. So right now we haven't made any adjustments to that capacity based on our sentiment on volatility right here, because it seems to be middle of the road. And personally, we don't feel that the VIX and the volatility has been connected to the market like it has been in the past. That there seems to be some sort of disconnect with the VIX and the S&P.
Oh, yeah, it's been kind of crazy, hasn't it? I've noticed that. Have you noticed that there is? Do you feel like there's been an increase in the average investor, not only using options as a hedging vehicle, but also using them in a premium selling side? I mean, I just think back from 5 years ago how few people are doing this. Now there's major funds, there's individuals. I mean, what's your take on kind of this wave of demand to sell premium that's kind of out there? What are your guys' thoughts on that?
Yeah, well, there's definitely been a huge rise in the interest of not just even just selling premium, just in options in general in the retail space. And I don't have the numbers in front of me, but the OIC did a study not too long ago that shows what these increases have been. The volume in listed options, and most of that growth is coming from what they would call a non-institutional trader or non-institutional investor. So there's definitely you can't ignore the fact that the listed option volume is growing and the capacity it's growing is from a retail perspective. So where it gets dangerous, so to speak, is if the growth in the listed option activity is coming from people that don't understand what options can do, good or bad, then it's a vehicle that may be causing more harm long term than good. So, we're not running a nonprofit altruistic shop over here. I mean, we like to think that we help raise awareness to the right parameters of education, and we get paid fees for helping people educate themselves and raise the awareness. There's definitely a lot of action in the options world, and sometimes I don't think it's coming from the right spots.
Speaking of that, information coming from the wrong spots and people diving in over your heads, given the explosion we've seen in, volatility interest, volatility trading with retail, VIX is quoted every day in papers around the globe now. It's really
and misquoted.
Yes, I think misquoted is probably more apt. But,
yeah.
I mean, do you have a lot of clients or ever have clients come into you, Mike, saying, hey, I really want to dive into, I want to start slinging VIX futures, I want to start slinging VIX options, I want to trade pure vol, and perhaps getting a little bit beyond themselves? Is that a scenario you encounter with more frequency these days?
VIX and volatility products specifically, yes. There seems to be that there's always the new thing out there. So the vehicle in the last 6 months has been more VIX and even silver and gold. The vehicles change with time, but the same principles always exist. We get calls all the time like, hey, here's the new thing, I want to do this. That's been going on since we started the company 5 years ago, and it's generally something that comes from the media. Well, not just the media, like the people that push out an idea, like here's the new thing. It could be Wall Street, wherever. Here's a new thing, and then the people get hold of that, and they're like, well, if I would have been invested in this from set time, I could have made X amount of money. So, in the last 6 months, I've seen a big spike in the people coming to us with VIX and volatility-related ideas, whether it's in an ETN like the VXX or the XIV. It seems like they're rolling out new volatility products weekly, and each one of every time they add a nuance to one of these volatility products, it gets more complex. And I don't think the average retail investor understands the nuances and complexities of these products.
Any of these ones that come out, you have to basically dig into the white paper to figure out what the heck the product does.
Right.
And they almost always have these unintended consequences. There are so many people that want to be self-directed. A lot of people come to me, they want education and they want to be self-directed. And I take in all kinds of people and I teach them how to trade, and I tell them at the end of the year when they're signing up, I say, in all likelihood, you're paying me to tell you not to trade and to get somebody that knows what they're doing. In your experience, how many people should really be fully KYO, and how many people probably need a KYO or a KY jelly to sorry,
nice.
That's my bad joke.
I was waiting for you to go there. I was just waiting.
I know. How many people need to stop getting KY jellied by the market and start getting KYO'd positive results on average? How many people do you think really belong to self-directed trading?
Sure. Now, and not only that, but I'll address that we might now have to change the name of our company.
Really?
Just from that. So
he can't be the first one to have brought that up.
Lubricant. So the KYO is a lubricant or a primer for the financial markets. How's that?
I like that. Yeah. You're a primer. You're a lubricant to profits.
There you go. No, it's a great question. I got my start like you, Mark Longo. We got our start in this industry on the floor of the exchange. And, we had mentors. We didn't just come up with a grub stake, go down on the floor, start trading, and have millions of dollars worth of successes. I had a year on the floor before I even learned how to correctly do the hand signals, let alone understand the nuances of the market and how to make money long term to be successful. I think a lot of people get introduced to investing and trading with how much money can be made. They see a picture of a guy driving a Ferrari and they say, what did that guy do? Oh, he was an options trader. They don't show you that he parked his car on South Financial Street across the river for $2 a day because he was a debit for 2 years. So people get introduced to the market on how much money they're going to make versus putting themselves in a position of consistently not losing money, understanding the nuances of the market before they go on to start making money. And once a person reaches that spot, some people have different learning curves. Maybe it's 3 months, maybe it's 3 years. But once you've gotten to that spot, then you've earned the right to be a self-directed trader. And we've had clients that have come in with no knowledge, and Mark Sebastian knows one of our clients that have come in with very little knowledge and have learned the right way and have gone on to start their own hedge funds. And we've passed the torch saying, look, you have educated yourself, you've put yourself in a position to become truly self-directed, to give yourself a chance at making this the vehicle for you to earn an income, to live your life. Here's where you can go to get a very low commission, a higher haircut, a better margining situation. Go on, young man, venture west.
So, Mike, I have a kind of a two-part question for you. As you're possibly aware, at the new venture that we are engaged in at the Volatility Exchange, we've created exchange-traded products, futures-like, that settle to the actual or the realized volatility of the underlying asset. And at the moment, we have the Euro FX trading on the CME, but we hope very shortly to be bringing out additional products on some of the more popular assets, such as the S&P 500, perhaps crude, perhaps interest rates, etc. So my question to you is kind of twofold. The first is, you mentioned the somewhat reticence of the public to trade some of the VIX products because they're complicated. They're not settling to an actual formula or a realized volatility, but just another estimate or forecast or guess. And I'm wondering, in your estimation, if such realized volatility products existed and were perhaps more easily explained to clients as simply, the calculation of the actual volatility that the underlying asset will go on to display, and transparently demonstrated and put up as a transparent market every day for people to look at. Do you think there might be a tendency for people to better understand such a product and want to trade it? And maybe even more importantly, you as a manager and as an advisor and as a portfolio manager, would you see such value, and would you be inclined to use such a product?
I'll go with the first question, of the two-pronged question there, with the how is the retail public going to grasp it? How is a self-directed investor going to grasp a volatility product? And then I'll venture into the as a portfolio manager, how would we use it?
Good.
I really don't see that much of a difference between myself and an educated retail investor. I just happen to have more clients or more assets than the typical retail advisor, because we're managing over 2,300 client relationships across the U.S. So we're just one big giant retail client. How's that? I think that most people think in terms of investing as having binary outcomes, meaning if I put $10,000 in my account at the end of the year, there's only really two things, unless it's like a freak of nature that you're exactly at $10,000 at the end of the year. It's either going to be more than $10,000 or it's going to be less than $10,000. So most people as an investor are thinking in terms of binary. So the easiest way to have a binary return is, if I have $10,000 and I want it to be higher, I'm going to buy a stock that I think is going to be up by the end of the year. if I'm more experienced, I may buy an option that I think is going to be up at the end of the year. So I think that the challenge of making a volatility product stick is to, even though it's non-linear and it's got a whole bunch of things going on, you have to make it as binary as possible. So a retail investor or an advisor like myself that is, a giant retail client, so to speak, I have to see it in terms of binaries. Like what place does this fit in my portfolio? Is volatility an asset class that belongs in a modern allocation in a portfolio? Or as a trader, is this something that I can understand where if I put X amount of money in at the end of the year, what are the chances that it's going to be up? What are the chances it's going to be down? How much is it going to be up? How much is it going to be down? And that just takes time. You're going to have to test the marketplace. But I think getting it transparent and easy to understand in binary sense is probably the most important or impactful to get people investing and trading it.
Okay, well, that's a fair assessment. And of course, in this particular case, it is a binary product because you're actually entering at a certain level of volatility, much the same as over-the-counter swaps, where there's a strike price for the instrument. So you might say, I'm going out right now and I'm investing in 1 month or 3 month or even 1 year volatility. The price is 15. And again, if at the end of the period volatility turns out to be 15, well, then I'm going to make money, and lower than 15, I'm going to lose. So I think I could explain the product rather simply to someone, the same as they would make or lose money with the stock example that you just mentioned, but the underlying is the actual movement without regard to direction, the volatility, the fluctuation of the underlying. So I think from an educational point of view, it's not beyond the average investor to be able to grasp such a concept. But as a follow-up question, I might ask you, perhaps as a portfolio manager, whether beyond the pure speculative nature, which is it goes up, I make money, it goes down, I lose money, unless, of course, you're short the instrument rather than long, is for the purposes of hedging. And the question there might be, I already have a portfolio, and maybe it's an equity portfolio, and maybe my returns are decent or whatever, but I'm experiencing a great deal of volatility, a lot of fluctuation. My drawdowns are big, and it's nice when I make money, but not so nice when I lose. How about the prospect of a volatility instrument as a hedging vehicle that can actually smooth out the fluctuations, in this case, let's say, of an equity portfolio, and the value to perhaps a Sharpe ratio or something of that nature beyond just the speculative part?
Yeah, that's a very powerful schematic. Like if you can get a portfolio manager, whether they're a hedge fund or just a regular advisor in the independent space that is doing things to hedge volatility in the client's portfolios, or even an individual investor, if you can get them to understand that, I think it's very powerful. I think there are thousands, if not millions, of investors right now that look at the market, they see low volume rallies, and then an unemployment number that comes out, and the market immediately goes down 1.5%. There's a lot of people scratching their head saying, I don't know where to put my money. I know I need to be in the stock market in some capacity, but I can't take these swings. If you have a volatility product that's able to help hedge the volatility in the return, it's very powerful, and it's very timely. My question for you would be, the structure of the product, I think, is just as important as what the product does in the marketplace. There was a couple of years ago one of these structured ETFs. It was like a double 2x ETF on crude oil, went delisted because they no longer had the capacity to keep up with the underlying, with how the ETF was structured. So I'm sure the brilliant minds at your company and the Volatility Exchange had all of that pegged and figured out. But people still have questions about that. And I always use the analogy that the FDA puts the warning labels on cigarettes. Don't smoke this. Pregnant women shouldn't smoke. The warning labels are there for a reason. The less warning labels that you have on this product, the more easy it is for people to understand, and the confidence they have on the structure of the underlying, I think, is just as important as that binary component of up and down.
Well, I'm glad to hear that, because we'd like to think that we've kept it as simple as possible, and as a result, we think that eventually the public will embrace the simplicity of the product, which again is simply a straight standard deviation calculation over a given period, with the actual closing prices determining daily volatility from the returns, such that the information will be disseminated each day, and people, it's kind of what you see is what you get, rather than kind of your guess is as good as mine when you start looking at implied volatility. So I'm actually glad to hear you say that, because we have considered the structure of the product, and we really try to make it as simple as possible. If it would be compared to any other volatility products that are out there at the moment, I think an objective person would always come to the conclusion that our product is as simple and as easy to understand, if not more so, than anything that's out there.
Yeah, and and I'm sure you guys have put a lot of thought into it, and it is an exciting product. The thing that I've learned over the past 5 years, when you're hedging a portfolio, or you're hedging a stock, or you're hedging an individual position, whether it's a stock, future, an ETF, is the desire of the portfolio manager to want to get more creative and undersimplify things. We've evolved back to the more you learn, the sooner you find yourself back at the beginning. We like apples to apples hedges. We've done the beta weighted portfolio, where you own a slew of mutual funds in a qualified or a non-qualified account. You beta weight the movement in the portfolio, and then you hedge it using options or S&P futures or whatever. We've learned with time that apples to apples hedging is so much more of a hedge than trying to craft and configure a hedge based on apples and oranges. So if you own XYZ stock, the best way to hedge XYZ stock is with XYZ derivatives, whether it's an option, a single stock future, your volatility products that are coming out. If you can simplify and make a retail client, or an advisor, a portfolio manager, a hedge fund, at a pension, at a foundation, if you can get them to understand the benefit of the volatility product and how it hedges that underlying, and it's apples to apples, I think it's a very, very viable product.
Well, that's good to know. Thank you for your outlook. And I guess one final follow-up question might be, in the absence of such products, at least on realized volatility, at the moment, if traders, whether they be short-term or longer-term investors, actually want to try to take a position in pure volatility to of an underlying, the traditional or classical way has always been delta neutral hedged options straddles, and it can be costly because of the daily follow-ups, and you're not always guaranteed of perfectly replicating the volatility of the underlying. But I guess the question to you would be, have you ever engaged in such activity on behalf of your clients, or in the retail sector? Is there going on, or is that something that's almost considered more sophisticated than the appetite of the average retail investor?
It's a great question, and the answer is yes. We have employed different strategies like that. I would say for the average retail investor, it's probably not too complex or too complicated, but there's truly no need for those kind of complex hedges. People tend to need hedges the more money they have. I mean, that's just the simple fact of life. I categorize investors into two categories. I call them make-its and keep-its. 90% of the people that are trading or investing that are just starting out or that don't have the capacity of a large portfolio, I call make-its because they're trying to make money in the market. The other 10% are what I call the keep-its. And they've already made their money, whether it's through business or selling a business or inheritance, whatever it is. They have their money and they want to keep it. And when you deal with keep-its, the people that have money and want to hedge it, those are the times you're going to find, hey, we need to come up with a hedging strategy. And if you own the stock and you buy, you own 1,000 shares of stock and you buy 20 at the money puts to create that straddle, so you're hedged going into an earnings report, and you can show the person that's doing that, it's probably a high net worth advisor or a hedge fund. If you can show me the cost savings in buying this volatility product versus buying the 20 at the money calls to hedge, or 20 at the money puts to hedge 1,000 shares of stock going into an earnings report, if you can show me the cost savings, or what it means to me as the advisor and the client of using the volatility product versus using the 20 at the money puts to convert the 1,000 long shares into a straddle, then I'm listening, definitely. So to answer your question specifically, yes, there are advisors, including ourselves, that come up with these kind of strategies, and it tends to be with people that have the need for it, that have money, that whatever the specific hedge they're looking for, and we're always open to, if we can understand the worst case scenario, best case scenario of a new product that we're going to use to employ a hedge, we can make sure that product can be understood by not only us, but by the client, and it's suitable. We're all ears.
Great question, Don. You read my mind on the delta neutral hedging. Your great minds think alike, as they say. I think that's all we have for you today, Aunt Mike. But thank you for coming on the show, and you only have yourself to blame for that nickname because you brought it up. I didn't even think of it.
I'm kicking myself for that. I like Grandpa better.
Grandpa, there we go. But we do want to thank you for coming on the show. And before you go, is there anything you'd like to let our listeners know about what's coming up at Know Your Options Inc. that they might be interested in?
Yeah, I mean, we've got and it has to do with the Option Insider too. So we've got a live show coming up for our other podcast, the Option Blog, July 21st in Chicago at the Elephant and Castle on Adams Street. We're really, really excited about it. We're going to have a bunch of door prizes and special guests. So we're really excited about doing the live podcast, 1-year anniversary show. So if you're in Chicago, if you're traveling to Chicago and be in town that Thursday, we'd love to see you.
I hear that's a pretty crazy show. I'm not sure if I'm going to make that one. It might be a little bit too raucous for me. I don't know. That option block and those people you have on there, they're a wee bit crazy, I think.
Yeah, that would, in the pit at the Chicago Board of Trade, the old saying was, if you weren't shaking, you weren't trading large enough. So, with the option block, if your listeners aren't screaming, you're not raucous enough.
Yes, exactly. If they're not screaming and pounding their desks in frustration as they're hearing Sebastian say something else that's completely crazy, we're doing something wrong. Thank you again. And our listeners, if they want to learn more about what you guys are doing, they can go visit Know Your Options Inc. Be sure to put the Inc. on the end of there. If you go to Know Your Options, I believe it's a Fannie Mae site or something along those lines.
Yeah, something with mortgages.
Yeah, so I made that mistake once. I was like, wow, I didn't know Mike and Mike got into the mortgage game. But yeah, knowyouroptionsinc.com if you want to learn more, and you guys have your free 18-minute portfolio review. I recommend all of our listeners go there and check it out because you guys do a lot of great stuff over there, and we're glad you can make it on the show, and hopefully you'll be able to sub in for Uncle Mike next week on our sister show, their Option Block, and our listeners will be able to get even more Aunt Mike Cavanaugh.
Very good. Yep, looking forward to it. Don, great to meet you, and have a great day, everybody.
Perfect.
My pleasure, Mike. Thank you for coming. You're welcome back anytime.
Thank you.
All right, and that's going to do it for our Volatility Viewpoint segment, and now we'll roll right into the Crystal Ball segment.
And now we take a look at the Crystal Ball.
And welcome to the Crystal Ball. This is, of course, the portion of the show where we gaze deeply into the mystical fog of our crystal balls and attempt to divine the future of volatility and the future of the marketplace. And we'll kick things off with our volatility pit reporter, good old Mark Sebastian from optionpit.com. Mr. Sebastian, what do you see in your crystal ball, sir?
Well, it's earnings season, and we've got tons of debt problems in Europe. So all systems say volatility in currency, and I think we get a nice uptick in volatility in S&P. It's going to be great.
It looks like the missing, we were recording this on a Friday morning, and missing the non-farms boosted vol a bit across the board. The markets are selling off quite a bit. It looks like we're bouncing back from the lows of the day, though, so perhaps we'll just end up... Yeah, it's just junk. So this is, of course, the time to be selling premium again if you follow what's been happening the previous weeks. Oh, the worst of the downturn is over. Start hitting those bids and all those points.
Yeah. No, I mean, I think we're probably just going to head right back to 1280, and then pop right back. We're stuck. We are stuck.
There you go. Put on the 1280 13.5 strangle, says Mr. Sebastian, and you'll be sitting pretty.
We're like a fat guy at a gymboree.
I don't know if that's very pretty. That's more mildly disturbing.
Yeah. We're stuck.
Thank you for that disturbing image, Mr. Sebastian. And of course, Don, you also have your crystal ball primed and polished and ready to go. And what do you see as you gaze into the murky mist of the future of Euro Vol?
Well, of course, we have the expiration today that I spoke of a little bit later. And, of course, we've got the other products that are now coming out as the new August. It'll be always interesting to take a look at how the traders are assessing future volatility, and to that extent, I always like to take a look at our Volatility Institute forecasts from Professor Engel, Rob Engel, and the group, and they tend to be somewhat on the lower side. I'm looking at an August forecast that's actually in the low 11s, so at least with some of the GARCH modeling, the call is for a little bit of an abatement in terms of Euro volatility. We'll, of course, see how that turns out.
I haven't been on the Volatility Institute in a while. Do they run forecasts for the broad market vol as well, or primarily for the Euro vol there?
No, they have a tremendous amount of underlying assets, hundreds and hundreds of them. And so if you go directly to the site and then the V Lab for Volatility Lab, they are actually disseminating and publishing GARCH forecasts for hundreds of underlying assets. You can also actually find it on our site because we carry the 1 month, 3 month, and 12-month forward-looking volatility forecasts that are actually provided by the Volatility Institute. And so if you go on to our site in the data section and you go to VolX indices, you'll see both the backward-looking historical volatilities for a wide array of assets, currencies, equities, commodities, interest rates, and then you'll also see these forward-looking forecasts from the Volatility Institute. And in that case, we're actually seeing S&P 1 month at about 1660, 3 month at about 1740, 1 year closer to about 19 or so. So that's the most recent forecast coming from Professor Engel's group.
It's interesting because they're predicting a little bit of near-term, steadfastness involved with some longer-term increases in overall volatility.
Right.
Interesting. Well, thank you for that, Don. That's going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. And I want to thank all of my cohorts, my partners in crime here, for joining me on the show. Of course, we want to thank Mike Cavanaugh, our special guest, for coming on the program today. I also want to thank good old Mark Sebastian from optionpit.com for joining us on several segments today. And if listeners are interested, they should surf on over to optionpit.com to check out their life vest service that they have going on right now, or maybe life jacket that they call it over there. And of course, Don, you guys are always churning out something new over on the VolX.us website. So what is coming up over on VolX.us and at the Volatility Exchange in general that you want our listeners to know about?
Two quick items. One we mentioned before. If you go to our homepage and kind of scroll down to the bottom under coming events, you'll see the opportunity to sign up for our very own Mark Sebastian, who is going to be doing a webinar on understanding and trading currency volatility. He'll be answering general volatility questions, talking about our Euro VolContract, and listeners can register either on our site at volx.us or over on the CME site or the Price Futures Group. We're all co-sponsors of this particular webinar. So the date is next Tuesday, the 12th of July. It's 12 noon Central Time. It'll probably run for about an hour or an hour and a half. So we invite listeners to sign up for that. It's free, and we're sure that you'll enjoy Mark's insights. Second thing I wanted to point out along the lines of these forecasts that we were just talking about is we're about to put up a new charting application that will actually allow people to look historically at what the backward-looking historical volatility is for a broad number of assets, and then go forward to the actual forecast of the Volatility Institute and chart one against the other. And they can do it in two different ways. They can just freeze time and say for any given moment what was the historical backward-looking and what was the forward-looking forecast. But even more interesting in my point of view is to do that with a lag such that you actually overlap the forecast with what actually turned out to be the historical for that particular period, since you've now, in theory, gone past it. So it's a way of actually looking to see how good or how accurate those forecasts were, kind of matching up on a chart, one superimposed on the other, the Volatility Institute forecast and then the actual volatility for that particular forecasted period. So it may not be up today, but it's going to be up very shortly, and we encourage listeners to take a look at that in the data section.
As I said, you guys at VolX are always churning out something new on the website. I always like to surf over there every now and then just to see what you guys have coming up, and that does sound like a great tool. I would also encourage our listeners, if they do want to check out that webinar and they want to sign up for it on your website, to make sure to scroll down. It is indeed below the fold, so if you go to volx.us, you won't see the events right away. You have to scroll down to the bottom of the page, and there you'll see the coming events section. So if you just surf over to volx.us and don't see the events and want to register, don't be disheartened, just scroll down a little bit. But I do encourage you to check out that webinar, and indeed, we have been off for a little bit, so we haven't had as much time to delve into the old mailbag and the old readers forum, and I think because we have been on a hiatus, a lot of you have been holding off on your questions, but now that we are back, indeed, we'd like you to go back in and send us your questions about volatility and volatility trading or the broad options market in general, and we will do our best to answer them. I know Don is surfing in there and checking it out on a regular basis, so he will usually beat me to the punch, but we'll both try to answer your questions. So by all means, post a question in the optionsinsider.com forum. Just hit the forum tab and scroll on down to the listener questions section for Volatility Views, or you can send us an email, questions@theoptionsinsider.com, or you can send an email over to Don at info@volx.us. Just be sure to put Volatility Views somewhere in the subject line so Don knows it's for this show. And some of you can even surf over to Facebook at facebook.com/optionsinsider. You can post questions for us there, or on twitter.com/options or twitter.com/volx_info. There are numerous ways to get in touch with us, and even the hale and hearty among you can leave us a voicemail at 312-544-9356. But that is going to do it for this episode of Volatility Views. I want to thank all of you out there for downloading and streaming and subscribing to this show and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.